January 1998. Seoul was not under bombardment. There were no air raid sirens, no foreign soldiers marching through the streets. And yet, across the capital of South Korea, one of the most haunting scenes in modern economic history was quietly unfolding. It was the heart of winter. The cold was brutal. The wind cut through concrete and steel like a blade. And in that freezing air, tens of thousands of people were standing in line. They queued outside banks, outside schools, outside community halls. The line stretched for city blocks. There was no shouting, no panic, no chaos. Only a heavy, disciplined silence. These people were not waiting for food rations. They were not fleeing a war zone. They were not seeking shelter. They were standing there to give away what they owned. A housewife carefully removed the wedding ring she had worn for decades. A grandmother unclasped a pure gold hairpin passed down through generations. Businessmen laid down gold watches that symbolized entire lifetimes of work. An athlete quietly placed an Olympic medal on the table, a national honor, surrendered without ceremony. No one forced them. No law compelled them. No gun was pointed at their heads. They came voluntarily. Within months, more than 3.5 million South Koreans, nearly a quarter of the population, donated their gold to the state. Not cash, not stocks, but physical gold. Personal histories, family memories, markers of identity. All of it was collected, melted down, cast into bars, and shipped overseas to the United States, to Europe. A nation was liquefying itself to pay a debt. But a debt to whom? Not a debt from war, not from famine, not from natural disaster. South Korea had been the shining success story of post-war Asia, a country praised by Western economists, a model of discipline, productivity, and growth. And yet its people were told that without this sacrifice, the nation would collapse. A debt so vast that most citizens could not explain where it came from, why it had grown so large, or why ordinary families were now expected to pay it with wedding rings and Olympic medals. Behind that debt stood a savior that had just arrived in Asia. It did not come with tanks. It did not come with warships. It arrived with a suitcase full of money and a contract filled with conditions. That savior was the International Monetary Fund, the IMF. What was happening on the streets of Seoul was not an act of romantic patriotism, as it would later be framed in documentaries and textbooks. It was the final, tragic act of a process that had begun months earlier. In the humid heat of Bangkok, history records it with a sterile name, the Asian financial crisis of 1997. But for those who lived through it, for the millions who lost their jobs overnight, for the families whose savings evaporated, for the men who discovered they could no longer provide for their children, it was not a crisis. It was a raid. It was the moment the West, led by the IMF, arrived claiming to extinguish a fire, only to pour gasoline on the flames, then wait for the ashes to cool and purchase the ruins for pennies on the dollar. To understand how 50 years of development could vanish in a single week, we cannot rely on official reports or sanitized headlines from the 1990s. We have to examine the mechanics of the trap itself. A trap constructed years before the first currency collapsed, built on cheap money, overconfidence, and a fatal misunderstanding of who truly controlled the global financial system. But to grasp the scale of the fall, we must first understand how high Asia had climbed. Before the chaos of 1997, East Asia was not merely growing, it was ascending. For nearly 3 decades, countries like South Korea, Thailand, Malaysia, and Indonesia had achieved something that much of the post-colonial world had been told was impossible. They transformed themselves from poor, agrarian societies into industrial powerhouses in a single generation. These were not paper economies. They built factories, not fantasies. They exported cars, ships, electronics, steel, not promises. In the ruins left by war and colonialism, they constructed what the world would come to call the Asian miracle. And the West applauded. The World Bank published glowing reports praising their fiscal discipline. Western economists flew in, took notes, and marveled at the results. Universities taught the East Asian model as proof that development could be engineered through hard work, education, and strategic planning. Seoul, once flattened by war, rose into a neon-lit metropolis of glass and steel. Bisan became one of the busiest ports on earth. Factories ran day and night, staffed by a workforce that believed deeply that sacrifice today meant security tomorrow. In Kuala Lumpur, cranes dominated the skyline. The Petronas towers climbed higher and higher, piercing the clouds, eventually becoming the tallest buildings in the world. They were not just office towers, they were a declaration, a physical signal that global power was beginning to shift eastward. For the first time in centuries, it felt plausible that the future might not belong exclusively to Europe or America. Money poured in from everywhere. Wall Street banks, London fund managers, European pension funds. They competed aggressively to lend money to Asian banks and corporations. If you were a Western investor in the mid-1990s, Asia was not optional. You had to be there. The growth was too fast. The returns were too high. The optimism was intoxicating. Capital flooded the region at historic levels, and with it came a dangerous assumption, one that would later prove fatal. The assumption was this, that the miracle was permanent. But beneath the surface, beneath the skyscrapers and export statistics, there was a flaw developing in the foundation. Not a visible crack, not a sudden weakness, but a structural vulnerability, one that was being carefully paved over with gold. The problem was not simply that money was flowing in, it was the kind of money. This was not patient capital looking to build over decades. It was hot money, short-term loans, chasing yield, ready to flee at the first sign of danger. Asian banks borrowed heavily in US dollars, taking advantage of low interest rates in the West. They then lent that money domestically, in local currencies, to developers, manufacturers, and infrastructure projects. On paper, it looked efficient. In practice, it was lethal. This entire system rested on two assumptions. First, that Asian currencies would remain stable against the dollar. Most governments had deliberately pegged their currencies to the US dollar to reassure foreign investors. A Thai businessman believed that 25 baht would always equal $1. A Korean executive trusted that the won would not suddenly collapse. Stability was the bedrock of the miracle. Second, the money had to keep coming. As long as capital flowed in, debts could be rolled over. As long as the music played, everyone could keep dancing. But by the mid-1990s, something began to change. The conductor of the global orchestra was not in Asia, it was in Washington. The U.S. economy was strengthening, and the Federal Reserve began raising interest rates. As American rates rose, the dollar grew stronger, and because Asian currencies were tied to the dollar, they were dragged upward with it. For exporters, this was devastating. Suddenly, Korean cars and Thai electronics became more expensive on the global market. Exports slowed, profit margins thinned. At the same time, China quietly devalued its currency, undercutting its neighbors and capturing market share. The Asian tigers found themselves squeezed from both sides. But instead of slowing down, borrowing accelerated. Banks and corporations, intoxicated by a decade of uninterrupted growth, took on even more dollar-denominated debt. They believed the peg would never break. They believed the government would always step in. They did not understand that somewhere deep inside the global financial system, a different logic was taking hold. A colder one. In New York and London, a new class of predator was watching. The currency speculator, and they were beginning to smell blood. Financial crises never begin with panic. They begin with doubt. In early 1997, that doubt centered on one quiet question whispered in trading rooms from Hong Kong to London: what if the pegs don't hold? For years, Asian governments had promised that their currencies were anchored to the US dollar. They said the exchange rate was stable, predictable, defended by massive foreign exchange reserves. But promises are only credible if they can be kept. And Thailand was the first place where traders realized they could not. Thailand's boom had been spectacular and reckless. Bangkok was drowning in construction cranes. Office towers rose faster than tenants could fill them. Luxury condominiums sold to speculators who never planned to live in them. The money funding this expansion came largely from short-term dollar loans. Thai banks borrowed cheaply abroad, then lent aggressively at home. Real estate developers piled on leverage. Land prices detached from reality. Everyone believed the same thing. If anything goes wrong, the government will defend the baht. But defending a currency peg is brutally simple in theory and brutally expensive in practice. When traders sell your currency, your central bank must buy it. To do that, it burns through its dollar reserves. And Thailand's reserves were not infinite. In the spring of 1997, hedge funds and currency desks began testing the baht. They sold it in massive quantities, betting that the Thai central bank would eventually run out of ammunition. At first, Bangkok fought back. Billions of dollars vanished from the central bank's balance sheet as officials tried to maintain the illusion of control. Publicly, they denied everything. There was no crisis. The baht was strong. Speculators would be crushed. Privately, panic was setting in. By May, the truth could no longer be hidden. Thailand's reserves were dangerously depleted, much of them tied up in secret forward contracts that made the situation even worse than advertised. On July 2, 1997, Thailand blinked. The government abandoned the peg. The baht collapsed almost instantly. What had been 25 baht to the dollar became 30, then 35, then worse. And in that moment, the crisis stopped being local. Because every investor in Asia saw the same thing. If Thailand could fall, who was next? Money fled not just Thailand, but the entire region: Indonesia, Malaysia, the Philippines, South Korea. Currencies plunged in sequence, like dominoes kicked over by invisible hands. For Asian corporations, the consequences were catastrophic. Their revenues were in local currency, their debts were in dollars. As currencies collapsed, their debts effectively doubled, sometimes tripled overnight. Companies that had been profitable for decades became insolvent in weeks. Perfectly viable businesses were destroyed not by bad products or poor management, but by exchange rates. Banks followed them into the abyss. Loans turned sour. Balance sheets imploded. Credit froze. In Indonesia, the rupiah fell so fast that prices changed between morning and afternoon. Inflation devoured savings. Food shortages spread. Riots erupted. The Suharto regime, once seen as immovable, cracked under the pressure and collapsed. In South Korea, the situation became existential. This was not a developing backwater. This was the world's 11th largest economy. Chaebol's industrial giants like Daewoo were buried under mountains of dollar debt. Foreign reserves dwindled to days' worth of imports. By December 1997, Korea was effectively bankrupt. And when a sovereign nation runs out of dollars, there is only one place left to go: Washington. When a country runs out of dollars, it does not negotiate from a position of strength. By late 1997, South Korea was bleeding reserves by the hour. At one point, officials quietly admitted that usable foreign currency had fallen to less than $4 billion, barely enough to cover a few days of imports. Planes needed fuel. Factories needed raw materials. The economy was grinding toward a complete halt. There was no alternative. Korea called the International Monetary Fund. Officially, the IMF exists to provide emergency assistance to stabilize economies, restore confidence, and prevent collapse. In practice, it lends money only under conditions, and those conditions are never neutral. In December 1997, the IMF assembled the largest rescue package in history at the time, $58 billion for South Korea alone. But this was not a gift, it was a contract written in Washington, negotiated under duress, and signed by a country with its back against the wall. The conditions were severe. Interest rates were raised sharply to defend collapsing currencies, even though higher rates crushed domestic businesses already starved of credit. Government spending was slashed. Subsidies were cut. Public sector jobs disappeared overnight. Financial markets were thrown open to foreign ownership. Banks that had once been considered national assets were forced to sell shares often at fire sale prices to Western investors. Korean laws that had protected domestic industry for decades were rewritten in weeks. The justification was discipline. The theory was simple and brutal. Pain now would restore confidence later. But confidence for whom? Unemployment in South Korea tripled in a matter of months. Middle-aged workers, men who had believed they were secure for life, found themselves dismissed with cardboard boxes in hand. Suicide rates surged. Families sold jewelry, heirlooms, anything that could be turned into cash. In a haunting national campaign, citizens lined up to donate gold to help repay the country's debt. It was patriotic, it was heartbreaking, and it was necessary, because the alternative was unthinkable. Elsewhere in Asia, the story repeated with variations. In Indonesia, IMF conditions collided with a fragile political system. Subsidy cuts sent food and fuel prices soaring. Riots erupted, the social contract shattered. The IMF insisted reforms continue. Stability had to come first. Markets had to be reassured. But from the perspective of millions of ordinary people, it did not feel like rescue. It felt like occupation. Critics began to ask an uncomfortable question. Why were domestic workers, small businesses, and entire social safety nets being sacrificed while foreign creditors were largely protected? Why was the cure so perfectly aligned with the interests of global finance? Even inside the IMF, doubts emerged. Some economists later admitted that forcing austerity during a collapsing economy had likely made the crisis deeper and longer. But by then, the damage was done. Asia had survived, but it had not emerged unchanged. Ownership had shifted, power had shifted. And one country, watching from the sidelines, learned the lesson better than anyone else: China. While East Asia was collapsing in real time, China stood still. Not because it was unaffected, but because it refused to play by the same rules. In 1997, China was still a developing economy. Its GDP per capita was a fraction of South Korea's. Its financial system was primitive, opaque, and tightly controlled. Western economists mocked it for that. But when the crisis hit, those controls became armor. China did not peg its currency rigidly to the US dollar. It did not fully open its capital account, and it did not allow foreign capital to rush in and out at will. When speculators tested Asian currencies, China's door was locked. The renminbi held steady not because markets trusted it, but because markets were not allowed to touch it. Beijing watched as Thailand, Indonesia, and South Korea were forced to surrender economic sovereignty in exchange for emergency dollars. They watched factories close. They watched governments fall. They watched national champions sold for cents on the dollar, and they took notes. The lesson China learned was not that global finance was dangerous, it was that dependence was fatal. From that moment on, China's strategy hardened. Foreign investment was welcome, but only on China's terms. Capital controls remained, banks stayed state-dominated, and export surpluses were hoarded relentlessly. Dollars would not be spent, they would be stockpiled. By the early 2000s, China began accumulating foreign exchange reserves at a pace never seen before in history. Trillions of dollars were piled up not to be invested for return, but to serve a single purpose. Never call the IMF, never negotiate under duress. Never again allow outsiders to dictate domestic policy. Ironically, this strategy required embracing the very system that had nearly destroyed its neighbors. China recycled its trade surpluses back into U.S. assets, especially U.S. Treasury bonds, helping to finance American deficits while insulating itself from financial attack. It was a paradoxical bargain. China funded the system, but refused to submit to it. And the system allowed this because it needed China's money. By the time the world reached the 2008 financial crisis, the balance of power had shifted dramatically. Asian countries that had been humiliated in 1997 had rebuilt, but under stricter rules. Korea amassed reserves. Thailand kept buffers. Indonesia grew cautious. No one wanted to be next. The trauma of 1997 left scars that never healed. It rewired how Asia thought about money, sovereignty, and globalization. The Asian financial crisis was not just an economic event, it was a political awakening. And its final irony was this: the crisis was framed as a failure of Asian systems. But the system that produced it, the volatile, dollar-centric global financial order, remained intact, stronger than ever. The Asian financial crisis officially ended. Currencies stabilized, growth returned, skylines recovered. But crises do not truly end, they embed themselves. What happened in 1997 rewired the behavior of entire nations. It taught governments a single, overriding lesson: never be vulnerable to the dollar again. From that point forward, Asia stopped trusting the global safety net. Countries accumulated foreign exchange reserves not for efficiency, but for survival. Trillions of dollars were parked in low-yield assets, an enormous insurance policy against another sudden stop in capital flows. This hoarding of dollars had global consequences. It helped push down interest rates in the West. It fed asset bubbles in the United States and Europe. It quietly set the stage for the 2008 financial crisis. In other words, the response to 1997 helped create the conditions for the next collapse. Financial globalization did not retreat after Asia's trauma, it intensified. Capital continued to move freely, but the burden of adjustment shifted. Emerging markets became cautious, conservative, obsessed with stability. The West became leveraged, complacent, addicted to cheap money. The imbalance grew, and the dollar remained at the center of everything. For developing countries, the lesson was brutal but clear: open your capital account too quickly, and you surrender control. Peg your currency without infinite reserves, and you invite attack. Borrow in dollars, and you hand the weapon to someone else. This is why, decades later, countries still fear IMF programs. Why capital controls, once taboo, are quietly tolerated again. Why de-dollarization is discussed seriously, even if rarely achieved. 1997 also shattered a myth that crises are accidents. They are not. They are the inevitable byproduct of a system that rewards speed, leverage, and speculation while punishing patience. The Asian financial crisis did not happen because Asia was uniquely corrupt or incompetent. It happened because global finance demands openness but offers no mercy. The miracle was real, so was the trap. And the final truth is this: Asia survived by changing itself. The system did not.